it's Ryan here, and today we're going to be going into quantitative easing. It basically means you're printing money. Now, of course, it's not only about printing money, and today what we're going to be looking at is the mechanics of how it works, how it is that a central bank can directly intervene to inject money into the economy. So, what is quantitative easing? Looking at the Bank of England's Knowledge Bank section, what is quantitative easing? They are purchasing assets to stimulate the economy. Looking through it, it says here on that first line that it is a tool that they use to inject money directly into the economy. What they're then using this new digital money to do, which they've just created, is to then buy government debt in the form of bonds, which is referred to as QE, or sometimes also asset purchases, which effectively mean the same thing. And really, the heart of this is simple. You create new money, which is going to boost spending and investment in the economy. So, looking at why it is that quantitative easing is used, we should know that the objective of the Bank of England is to keep inflation low and stable at that 2.0%. Usually you would use this by changing the bank rate, which is the key interest rate in the economy. But if the bank rate doesn't seem to be getting people spending money, then quantitative easing can come into play, because by undertaking quantitative easing, by printing this new money, it's meant to be an extra boost to try to get people to spend and invest a little bit more. And that's why you can see that I've highlighted on the very bottom. It says that when we needed to act to boost the economy, we turned to another method of doing so, and therefore we introduced quantitative easing. Now, of course, the interesting thing is that before 2009, nobody had even heard about what quantitative easing was. They even used to make a bit of a joke out of it on the PM program, where they would have all these people on and say, can you say this new word, quantitative easing? And it was really difficult for everyone to say. But of course, now it's pretty standard, and it's an A-level economics topic. So how does quantitative easing work? They've got some information here, which we'll go into in a bit more detail later. But it says that large-scale purchases of government bonds lower the bond yields on those bonds. And we'll explain why that happens in just a minute. This pushes down the interest rates offered on loans, because the rates on government bonds tend to affect other interest rates in the economy. So we'll have a look at that in a minute. So therefore, by undertaking QE, it makes it cheaper for households and businesses to borrow money, which will therefore encourage spending. In addition, they say that QE can stimulate the economy by boosting a wide range of financial asset prices. So that's another way that quantitative easing works, and we'll look at that in an infographic in just a minute. And this last one here says if they bought £1 million of government bonds from a pension fund, that pension fund is then going to look to invest that money, and rather than hold on to it, they look for financial assets such as shares, which is equity in companies, and they're looking for something to give a return because the bond yield has now become lower. And so when demand for financial assets is high, the more people want to buy them, the value of these assets increases. This means that businesses and households holding shares are wealthier, making them more likely to spend, thus boosting economic activity. So two things that are explained on this slide. Number one, lowering the bond yield will lower the rate of interest for borrowing in the economy. And also by purchasing these assets, it raises the wealth in the economy, which gets people spending money. This is just a little bit of context. It's useful to know that the most recent round of quantitative easing at the time of recording this was actually just last month. So all the coronavirus stuff, they fairly quickly moved in and said, here's an extra just over 200 billion pounds of quantitative easing. Previous to that, they'd had rounds in August 2016, July 2012, and November 2009. And that's a cumulative effect there. So that means that the Bank of England currently holds 645 billion pounds of government bonds, which they purchased through this program. Now, the real thing that you want to be able to visualize is this diagram. So you start from left to right. If the inflation rate has gone low, then what the Bank of England will do is purchase assets, which is the quantitative easing task that we're looking at. Look at the bottom line down here. The bottom line is the standard understanding that I think most people, if they know what quantitative easing is, will be able to go through. Quantitative easing puts more money into the economy It means that with this extra money, banks are more willing to lend that money. So the banks lend it out to households and businesses, and spending increases, which is then going to push aggregate demand, pushing inflation back to its target. So that's the really simple one, this one down here, and it's useful to know. But what was explained in the other slide, and what's really useful to know as an A-level economist, is to say that by purchasing these assets, the asset prices increase, and that's that top line there. That has twofold effect. Number one, the top one where it says total wealth increases, because the Bank of England is now acting to purchase all these assets, the people who hold on to those assets are wealthier. By being wealthier, therefore they want to spend money, they're willing to lend money, and as a result, spending and incomes increases through the same mechanism of aggregate demand. So that's a useful one to know. The really good one to know though is this. By driving asset prices up, this pushes down bond yields. Bond yield is the return that you get from holding on to public sector debt from the government. So therefore, if the Bank of England steps in and starts to purchase these debts, purchase these bonds, it drives the price of the bond up, but because each bond pays the same amount no matter what the price was, the yield, which is a fixed amount divided by the price, is going to go down as the price goes up. And because the bond yields go down, cost of borrowing decreases, that's that middle line. As a result of lower borrowing costs, we see spending and income increasing, which will all push inflation back to its 2% target rate, which really we should know is meaning that people are spending more money and we're boosting aggregate demand. That's what we're trying to do. We're trying to boost aggregate demand through using this policy.
All right, so a bit more explanation on this whole bond yield thing, right? Using the old-fashioned, pen and paper. All right, so here's how we want to be thinking about the bond yield. So bond yield is equal to the annual payout divided by the price of the bond. Now, the key thing to note here is that the annual payout stays the same. The annual payout is actually fixed in the terms of the bond, and so therefore, if the Bank of England increases the price of bonds by increasing the demand for them as they're undertaking their asset purchases, this will have the effect of lowering the bond yield, which then, as we said, pushes down interest rates in the rest of the economy.
Another one that I like to throw in here is just a little bit of context. It's a few years out of date now, but it's interesting to note that this shows how much quantitative easing has been undertaken by different central banks over the course of roughly 10 years since the 2008 financial crash. You can see that the Bank of England had a pretty sharp increase, especially in sort of 2011, 2012. The US Federal Reserve has, as of 2014, has 5 times the number of US federal debt. The European Central Bank has been purchasing assets. And the interesting thing about the European Central Bank is from 2012, they were actually reversing that process. That's an interesting part of quantitative easing is that it is reversible. And as you can see, the Bank of Japan has also been undertaking quantitative easing, especially since 2013, when they were trying to find ways of stimulating the economy to fight the deflation they were fighting in Japan all those years.
So, a few other things that you want to look at in addition to this video are going to be a few things that I've got on my recommended watch list.
First one, from the Bank of England's YouTube channel, Does the Bank of England Print Money? 36 seconds on a very quick explanation to say, yes it does, and it's called QE. The next thing that I would definitely recommend, 3 minutes and 46 seconds, an absolutely essential video that goes into the mechanics of QE. The transmission mechanism, those forks that you see, this explains it all. In fact, I think that I got my slide as a screenshot from this video. It's well worth watching and well worth knowing to be able to make notes on why it is that quantitative easing works. And another bit of recommended listening would be this radio program from a few years ago, where they explain how quantitative easing works, and they actually go in and sit next to the person as they click on that button, which then creates hundreds of billions of pounds within the economy.
Well, I hope you enjoyed the video, and good luck with the rest of your revision.